In this video, we'll continue to talk about liabilities from advanced collection. Now, liabilities are created when we receive deposits or advanced from the customers. These are mainly about monies received from the customers. And we can separate it into three main categories. The first one is deposits and advance, basically the same name, from customers. Below, we can further separate it into refundable deposits. These are, you pay a deposit later to keep a container. For example, you rent a container, right? Or you rent the apartment, you have to pay deposit, which will be refunded to you when you kind of finish the lease. The second type is the advances from customers, right? For this one, famous example is the magazine subscription. Now, the second advanced collections are gift cards. When we purchase gift cards, business Christmas season is coming. You purchase gift card. These are for the companies, advances from customers, but also represent a liability until you use the gift card. The third one is collections for third parties. We are usually referring to the governmental units. In some business, it's typical to require customers to pay cash as a deposit that will be refunded when a specific event occurred. You probably have encountered such situations when apartments are rented, right? Securities or damaged deposits often are collected. Utility companies frequently collect deposits when service is begun. Similarly, deposits sometimes are required on some returnable containers. When the containers are returned, then the deposits will be refunded. This example in the slide talks about the container situation. So let's look at it together. This chemical company sells the combustible chemistries in expensive reusable containers. So mind you, the main business here is to sell the chemicals, not the containers. But you have to use the container to carry the chemicals. So customers are charged the deposit for each container delivered and will receive a refund, right, when the container is returned. Deposits collected on container delivered during the year was a total $300,000. Also, there are forfeited deposits if the containers are not returned within the allotted time, which is 1 year. And the company estimates that 90% of the containers were returned within the allotted time. Now, deposits charged are twice the actual cost of containers. While these are to calculate the situation when these containers are not returned, so we need to treat it as a sale, right? Then you need to calculate the cost of goods sold because you are selling the container. Well, then let's look at the journal entry. Number one, when we collect the deposits, this is usually at the time when we sell the chemicals, right? When you sell the chemical, you receive the revenue for chemical. Meanwhile, you also receive the deposit because they are using your container. So then the total is $300,000 listed. And when we have the cash, debited cash, we also have a new liability, and we call it liability refundable deposits. Next, when the customers returned the containers, we need to pay back the cash, right? So that's easy. We just switch the journal entry. However, the amounts are different. Only 90% of the customers returned the container. So I use 90% times $300,000. I get $270 here. But the account names are the same as the last one, right? Except that the debit credit are the opposite. Lastly, we need to also do the rest 10%. we treat those that do not return container, in other words, deposits are forfeited, we treat it as a sale. So when we do the sale, we have a revenue. Now, the company is selling chemicals. So this, we have to specify it is a sale of containers. Well, 10%, right, of the $300,000. Now we're gonna remove the liability for the refundable deposits. Next, we also need to, doing the matching principle. You have a revenue, you gotta have a cost. Cost of goods sold is only half of the value of the container. So that be cost of goods sold credit inventory. We also have advances from customers that represents the liabilities until the company provides services or selling the products. Now, the famous examples are gift certificates, magazine subscriptions, layaway deposits, special order deposits, airline tickets. We call these customer advances deferred revenue or unearned revenue, right? We are pretty familiar with this title. We've learned it so many times. Deferred revenue. And the famous example, of course, is gonna be magazine subscription. So let's quickly go over it again. Well, the publication company is called Tomorrow, all right? It collects magazine subscription from customers at the time subscriptions are sold. Well, the revenue is recognized over the term of subscription. Well, during the first year of operation, the total proceeds of cash is $20 million. At the end of this year, the average subscription was 1/4 expired. So that means 1/4 of the 20 million can be qualified as revenue. Now, when we collect the advance, in other words, when we collect the cash, we collect it in total of 20 millions, and we're gonna put it on the account of deferred subscription revenue, deferred revenue. Next, at the end, right, when the product is delivered, that's gonna be moving the deferred revenue to revenue. So before we debited this liability account for on the credit side, now we move it to debit. And why is it a 5? Because only 1/4 of the advances is expired. So 1/4 of 20 is 5. Now, concept track. You can pause here and do it yourself. The answer is D. Again, it's a simple calculation question. We have a total advance of 2,400, and then now it's 1/6. Next, gift card or gift certificates. Now, gift card or gift certificate are particularly common for these advanced payments. When a company sells a gift card, it initially records the cash received as deferred revenue, and then recognize revenue either when the gift card is redeemed or when the probability of redemption is viewed as remote. In other words, either it is expired or due to the company's experience, customers are most likely not gonna be redeeming this gift card. And we also call this gift card breakage. For my personal experience, I always found this e-gift card, electronic gift card, really easy to kind of, I will forget how many gift cards do I have, and whether there is remaining amount balance in this e-gift card, because it's really hard to find the emails. Now, going back to the gift card accounting, right? Let's look at an example. This company is called Great Buy, so obviously not the best yet. During May 2021, they sold $2 million of gift card. Also during May, 1.5 million of gift cards sold in prior period, so that's before the May one, were redeemed by customers. And 1 million of gift cards sold in the prior periods expired unused. Don't worry, we're gonna do this one by one. It's not like all together. So 3 sets of journal entry. Number 1, when we sell the 2 million gift cards, we're gonna record, that one is straightforward. We debit cash by selling gift card. Also, we have a deferred gift card revenue. Next, we're gonna record the redemption, 1.5 million gift card redemption. In this sense, we are gonna simplify it. In other words, we don't wanna talk about the inventory or cost of goods sold, because when you redeem gift card, you usually use a gift card to purchase things, right? Okay, so just focus on the gift card. Before, it was stored in deferred revenue. Now I move the $1.5 million from deferred gift card revenue to revenue. In other words, I'm going to debit deferred gift card revenue. Debiting a liability account reduces the liability. Lastly, for the expiration, $1 million, we're gonna remove it. How am I gonna remove it? Turn out we can just record revenue. Look at the second and the third set of journal entries. Same. Concept check. You can pause here and do it yourself. Now, the 2021 revenue is the 2,500 redeemed plus the, it's the $25,000 redeemed plus the 2,500 expired. So in total is 27,500. Well, you can basically double check by referring to these 2 sets of journal entry. Basically, we can record revenue only when for these 2 situations. Lastly, collection for third party. Companies also often make collections for third party from the customers or from employees and periodically remit these amounts to the appropriate governmental units. Now, the amounts collected this way represent liabilities until they are remitted. Common examples are payroll-related deductions, such as we withhold the taxes, employees' social security taxes, employees' insurance, employees' contribution to retirement plans, union dues, right? These create the liabilities, and it's the current liabilities, because usually we will help the employees submit it to the government periodically. And the journal entry here is simple. So look at the simple example, right? We assume the state sales tax is 4%, local sales tax 3%. A sale is made for $100. So when we make the sale, of course, we're gonna credit sales revenue for $100. But as a customer, we know we are not just paying the labeled price. We also need to pay tax. So the total tax is gonna be 4 plus 3% times 100, which is $7. We collect 107 from customers, and the $7 is gonna put in sales tax payable, a liability. This liability will be in our book until we pay the tax. Now we finished the liabilities from advanced collections. I'll see you in the next video.